We are on and back for episode 18 of the Capital Spotlight podcast with your host, Craig McGrother. And as always, the principal founder of Lone Star Capital, Rob Beardsley. How are you today?
I'm great. We're coming live from my office here at the One World Trade Center.
Yes, and the office did get a nice facelift. Would you say it's about 90% done and furnished, or closer to 95? Is it 85? Where does this fall in line with your vision?
Well, we moved in about a year ago, and it's taken us about a year to get furnished. So everything that you see here is just about a couple weeks old, which we got just in time for our annual event, where just a couple days ago, we hosted a lot of our investors, VIPs, and speakers for our event here in the office for a pre-party happy hour, which was really great. Everyone loved to see the office and kind of see what we have going on, and thankfully we were able to get pretty furnished just in time.
And this is a 5-year lease, correct, at the One World Trade Center?
That's right.
Awesome. So we'll have at least 80% of the lease left fully furnished and looking buttoned up like this. What we want to get into for the show today, just for the agenda items, is a couple things. So we're going to do the fund-to-fund model. We're going to go through that, how we're going to implement that to our capital stack, I guess more so because we've been using that for some time, but just come on and go through some of the nuances there. We're going to go through another theme, which is early access when we acquire properties, and just the escrow process on the front end, and also in the negotiation side, because I thought it was a little bit interesting. And then finally, if you don't want to listen to the recap of our event, tune out there. We figure we'll go with the meat and the potatoes on the front end, and then we'll dive into a recap of the show there. But let's get into the fund of fund model. So can you kind of break down, I guess what that means and how it works for us, and elaborate and don't spare detail?
Sure. So as you know, the fund-to-fund model has really gained a lot of ground recently, but it's been around for a while. But to explain it simply, people who want to participate in a deal by raising capital, they can do so by actually pooling their network of investors together into a special purpose vehicle, or a fund-to-fund entity essentially, and then that entity can become an LP in a parent vehicle, or the main deal that the investors want to invest in. And basically it's one entity, one check that invests into the main deal. In exchange for that, usually because you're aggregating a larger amount of capital together, you're able to negotiate better terms at the deal level, and then it's up to the fund-to-fund manager's discretion how they want to pass on those enhanced economics at the deal level to the underlying fund-to-fund LPs. So typically what you see is a fund-to-fund manager will aggregate, let's say, $1 million. That $1 million will go in as a single check LP into the main deal at enhanced terms, and then the fund-to-fund manager will have some costs at the fund-to-fund level, and they'll charge a fee for facilitating and also a small promote for facilitating as well. And in the end, the fund-to-fund LPs are essentially paying a double promote, where they're paying a promote at the deal level, they're paying a promote at the fund level, but in the end, because of the negotiations and the deal structure, the fund-to-fund LPs are getting typically the same return, or perhaps an even better return, than if they were to invest directly. And that's not to mention the fact that they're able to even invest in the deal itself, given that there might be some sort of minimum requirement. For example, the main deal might have a $100,000 minimum, but the fund-to-fund level has a $25K minimum, so they're able to invest $25K and get access to the better deal. You see that all up and down the spectrum, where institutional investment managers like a Blackstone or an Apollo, a lot of their flagship funds have $5 million minimums. So a $5 million minimum is pretty inaccessible for most folks, but if you create an SPV or a fund-to-fund, you can then tap into that opportunity. So that's the high level. Like I said, it's not a new thing, but it's gotten extremely popular as somewhat of a replacement to the co-GP model, which we have experience with as well. But moving forward, like you mentioned, we're going to be rolling out a programmatic fund-to-fund program with our partners, which I think is really going to be an awesome turnkey solution for those interested in partnering with us and raising capital with us compliantly, safely, cost-effectively. So yeah, that's going to be really exciting.
And just for the record, we have been using primarily fund-of-fund models into our deals. We are just revamping the process, and in addition to revamping it, we want to educate a lot of the people who are hopefully listening to the show that are thinking about raising capital, or also just thinking about deploying equity into deals. This is just kind of some of the nuances and inside baseball of the business that we want you to be aware of, which is great. So with that said, why is this model safer than the co-GP model or other models?
Well, I'm not a securities attorney, of course, but
Not yet, at least.
not yet.
Yeah.
Who knows? But the SEC does not like individuals to essentially, quote unquote, sell securities without a securities license, right? And that's a gray area, because what is selling a security? Are you raising capital, or are you acting as a broker dealer? But you aren't a broker dealer. So basically, it's a very safe way to go as a fund manager to form your own entity, because what actually happens is, if let's say one of our capital partners comes to us and says, I'm interested in your deal, I'd like to pull together $1 million so that we can all invest and I can make a little bit of profit on the enhanced terms, right? Well, we're going to provide them a turnkey solution from a marketing standpoint and from a legal standpoint. What that means is we're going to provide them a PPM and subscription documents for their fund vehicle. And what that does is they're the person actually issuing the securities, right? They're doing their own issuance aside from our deal level issuance. So they're not riding on the back of our issuance. They're not handling our securities. They have their own quote unquote securities. And the reason why I say quote unquote securities is because these aren't public stocks or anything like that. But technically speaking, when you do a Reg D 506B or 506C offering, you are selling partnership interests in an LLC or LP, which are securities. And the fund-to-fund manager is selling their securities through their own exemption, not our exemption. There's no partnership. They're not being compensated by us, so we're not paying them to raise money for us. That's not the relationship. They're actually getting compensated at the fund-to-fund level by their own LPs. So that's why it's compliant and very safe.
Gotcha. So in the fund-to-fund model, effectively the investors pay for the due diligence fee to the fund manager, which is great. So that's something that a sponsor would theoretically not have to pay out there, which is awesome. In addition to that, how does depreciation work for a fund manager? With regards to how the deal structures and flows. Does it flow to the fund manager? Do they keep all the depreciation? Do they elect to give their investors a certain level of depreciation? Can you kind of walk through that, please? Because specifically for real estate deals and what we do, depending upon the leverage, that's a very enticing way to maximize an investment, right? So can you maybe dive into that?
So the fund-to-fund model gives the fund-to-fund manager ultimate flexibility. So they can decide how they want to allocate economics, also how they allocate depreciation at their fund-to-fund level. They have full discretion on that, right? So that's up to them and how they want to handle that. So there's not really anything that we dictate on that front.
Gotcha. And one thing I think is really interesting and cool about the fund-to-fund structure, specifically how it works with our deals. So just for people who maybe are or are not aware with how our structuring works, we have two class shares, right? So we have Class A and Class B. Class A is a minimum of $50,000 for an investor to come in, and then Class B is $500,000 for an investor to come in. So the difference between these two are just the waterfall setups. So I'll run through that real quick. For a Class A investor, as I mentioned, minimum $50,000 check all the way to $499,000. That's an 8% preferred return, up to a 70-30 split to 15% on the IRR, and then 50-50 following the 15% on the IRR. With the Class B shares, it is a $500,000 minimum with a 9% preferred return, which is cumulative and compounding for both the preferred returns, just so I can make that clear, and then a 70-30 split throughout. However, with the fund-to-fund structure, let's say if the fund manager were to raise $1 million and you were to invest $30,000 with that investor, there's a chance that you could actually get the enhanced economics for your investment as opposed to what the Class A would be. So it's beneficial for all parties involved, I think.
Yeah, again, it just depends on the structure of the fund-to-fund manager. We're not there to dictate, but we are there to help facilitate the fund-to-fund process and for the fund-to-fund manager to make money. Obviously, we want our partners to be incentivized and work with us time and time again. And so to create a sustainable partnership structure where everyone wins, we as the sponsor win, the fund-to-fund manager wins, and then the underlying LPs of the fund-to-fund win as well.
Absolutely. Is there any other nuance that we didn't cover in reference to the fund-to-fund model that gets you excited as well, other than, of course, the safety and then also the new people we'll be working with in the system?
I think it's scalable, which is exciting. I have a vision for us to scale up and have many fund-to-fund partners. It's infinitely more scalable than a co-GP partnership because you're limited in terms of how many co-GPs you can have in a partnership, just reasonably speaking. So I'm excited about the scalability, being able to bring on partners that we otherwise would not be able to, just because they might be emerging fund managers and they might be unable to raise, let's say, $1 million. So that's an opportunity via the fund-to-fund to, let's say, partner with another fund-to-fund manager, group up. Let's say we match make, and when there's two emerging managers, and together they can, let's say, raise $700,000 or $1 million, and so cumulatively they share the legal costs of the fund-to-fund, and then they share the profits, of course, and they get to build their track record and relationships with their investors by getting in the game.
It's a lot more flexibility, right? Because before, if it's just the co-GP model, it doesn't make sense to bring in a co-GP who's bringing in maybe $500,000 or $700K. But with a fund-to-fund structure, it's just more compliant and a lot more simplistic, which is incredible.
Yes, for sure. So another thing that's interesting is I've said a couple times that this is not a new concept, but
no,
the way that we're rolling out and the way that the industry is gravitating towards
it's
this.
It's shifting right now.
It's shifting, and the costs have come down as well. As far as legal, back in the day, and I'm sure there's still lawyers out there that still do this, they might want to charge you $25,000 for a PPM. And we're talking about a very simple PPM here. Basically a PPM right? That mirrors the main deal's PPM. Basically the sub PPM or the fund-to-fund PPM is simply going to say, okay, this deal is being formed solely for the purpose of investing in deal X, and then here's kind of the manager's roles and responsibilities, here's the risk disclosures, done. That should not be $25,000. And if it were, let's just say the market price was $25,000, that would make a fund-to-fund absolutely uneconomic. Because if you're going to raise $1 million, but then bear the cost at the fund-to-fund level of $25,000,
there's so much of your upside on the back end theoretically, and in the front end, it's like, well, why would I even do this to start with?
No, yeah, that's 2.5% of your fund right there. So that's creating a big drag on returns. However, in our structure, we've been able to get the costs down considerably, and that makes the fund-to-fund model economic, and that's why we're seeing the widespread growth of this model and making it accessible to smaller fund managers. Like I said, this is not a new concept. I mean, if you look at, pretty much all of the private equity firms that invest with us, much bigger checks, $5, $10, $15, $20 million, they're structured the same exact way. They have their underlying LPs, which might be institutions and endowments, and they pool those funds together, charge an asset management fee, charge a promote, and then they find investment opportunities like ours to partner with, and they're an LP with us. So we charge them a promote, then it trickles down, and then the institutions, endowments, pensions, etc., they are the underlying LP. So the double promote and the fund-to-fund model is not new, but I'm excited that it's getting more accessible. With technological innovation and financial innovation, I feel like the best kinds are the democratization of access to these sorts of products, which goes back all the way to 2012 with the Jobs Act, where that legitimized crowdfunding and being able to raise capital through a Reg D or 506, a 506B or C offering.
Awesome. And, what I really like is, and I don't know if you want to share or not who we're kind of working with right now. There's a couple people, but I won't get into specifics just because things are kind of moving right now. But we are moving in the right direction with an awesome group who was just attending at our event. But it's really cool because they streamline the process so much for the fund manager. The pricing is incredibly competitive, which is awesome. But in addition to that, they're really streamlining the process. So in the co-GP model, it makes it a lot more challenging because there's people basically investing directly to us, or if there's a big partner who can fulfill those buckets. But in the fund manager route, we don't have to worry about any of that. They just bring in one check, when we need the money, and it's so simple. It really is special. It's less tracking in our end. All parties are truly winning in this, with this enhanced implementation of the fund strategy. So we're really excited about that. And then a call to action, if you are looking to raise equity, we have a goal of, was it 2 new fund managers you want to speak with and meet a week, is it correct? Or 100 through the year? So it is 100 new ones. So starting today, no New Year's resolutions. If you want to get something done, if you have a goal to do it, the best day was yesterday to do it. So we're going to start this now. We're going to put it out here to you. First, our goal is to get 100 new fund managers in our system that we're raising from, in addition to the ones that we currently have in our bullpen and staple of capital partners. So if you're looking to raise money, please reach out to myself, craig@lscre.com, or go to lscre.com if you want to go through our website. We'd love to kind of give you a breakdown of some of the costs associated with it once we have the sheet finalized, and also what we're looking for to be a good mutually beneficial partnership, and hopefully we share the common goal. I know there's a lot of people that may be watching this but have never reached out, so if this is your chance, the water is fine. I'm a friendly person. We'd love to get you into our system. So.
Excellent. Yeah. Well, I think that wraps up my thoughts on the fund to funds.
Yeah, no, it's just really exciting. It's not, as I said, we've been doing this, but we really just wanted to kind of harp on this point today as we were feeling incredibly inspired following our event that we had, which we'll get into after this next topic. What I want to speak on now and get your thoughts on, which is something I want to make a more specific video about, or at least have you make a specific video about, maybe an episode perhaps, but the value and importance of the front end of the escrow process and the premise of early access, which you want to turn that light back on?
We look fine without it.
Fair enough. Well, you look good in every lighting.
Thank you.
Sometimes I look good in okay lighting. But yes, let's talk about early access as it pertains to an escrow. So why don't you kind of give us your breakdown that in the best Rob Beardsley fashion possible.
So not everybody does this, but we put an early access provision in all of our LOIs, or letter of intent. And so basically when we're bidding on a property to purchase, we are willing to go non-refundable with our earnest money deposit day one. That means we're going hard day one. And that's very attractive to a seller because that provides them more certainty of closing, and they're able to keep that deposit in case we decide to walk away from the deal or are unable to close. So a hard deposit is attractive, and we'll get into some interesting ideas about that, or I guess updates in the market about that. But in order for us to feel comfortable, because it's quite a risk to go non-refundable with your deposit day one without even doing any inspections. So in order to get comfortable, we put in this early access provision, which basically the intent of it is simultaneously as we are negotiating the PSA, we do a one-day early access where we come on site and we randomly inspect 10% of the units, 10% of the lease files, and we also do an exterior site inspection. It's not super rigorous. We don't bring a ton of engineers out. It's not very invasive, and it only takes a day. So we think it's quite reasonable, and I'd say most sellers agree, because if we're willing to offer the hard money in exchange for this, I feel like that's a good offer. However, when times were very, very hot and competitive, groups were willing to go hard day one without any early access or anything like that, with limited information up front. That's just risky, and we did our best in those tough times to stay away from that. We would maybe get creative and maybe have to negotiate on the fine terms of the early access. Maybe instead of 10% of the units at random we would inspect, maybe they would actually only allow us to check out the vacants, which is an okay compromise. So, however, we are no longer in that super hot competitive market. And so what we've seen is the demand, or the leverage that sellers have to demand hard money, has gone down. You're able to actually get deals done or put deals under contract without hard money day one. You can actually have a full 30-day due diligence period and then go hard, which is obviously really good. We have gotten accustomed to going hard day one, and we are willing to still do it. And so because the market's come down and sellers have less leverage, going hard day one gives us a little more leverage than in ordinary times. So if we want to stand out and be the winning bidder on a deal, not just because we have the highest price, but because we have better terms, then going hard is still in our interest. However, it depends on the situation. Sometimes we're still putting out soft offers because the deal might be hairier, we might be less familiar with the situation, and we want that protection.
Maybe we're giving a broker a favor by giving them an offer just so they can get a price reduction because we're good friends of the business, right? So
that's true too.
Yeah.
Yes, that's a little higher level stuff, but yeah, so that's kind of the reason behind the early access and how we implement it. So it's just interesting because we still get pushback on it. Sellers still sometimes say, yeah, this early access thing makes me nervous. I don't want you to come around, kick the tires, and just waste my time, tie me up, which I understand, but I honestly don't really understand that either.
So if you get early access, does your hard money not become non-refundable during that process? Is it kind of a contingency plan to the hard money, making it not necessarily hard for kind of your earnest money deposit?
Well, that's a good question, actually. So early access agreements are different. So sometimes the way we'll do it is we will have the early access prior to signing the contract. So we're not even under contract, but the seller will allow us to come on and do that 1 day early access. Which, okay, we haven't signed any contract and we haven't posted any funds. So that's just easy. We do the early access. If we feel comfortable, a couple days later, we'll sign the contract, wire the money. Other times, sellers prefer us to actually sign the contract, really show that the deal is on, but not wire the funds yet, and then do the early access, and then fund. So it kind of depends on what steps you're in, but at the end of the day, the whole point of the early access is to be able to do a mini due diligence and then go hard.
Gotcha. So during that process, we're looking to identify, and I was talking to Brad and the team about this just a second ago earlier when you were, I think, in a meeting with Kent, but we're basically trying to get 10% or so roughly of the units to tour through, not just the model units, right? Is that correct?
Mm-hmm.
Okay. And then what are we looking for on that tour? Are we looking just to see how beaten up they are, what the CapEx is going to look like, price per unit? Kind of walk us through that maybe.
Yeah, I would say most importantly, we are looking to ensure that our budget, meaning our CapEx budget, is not going to get blown up. The worst thing you want to do is, let's say, bid $40 million for a deal and you assume that you're going to spend $4 million on renovations, but then you do your due diligence and you come to find that the interiors are in worse shape than you thought, and maybe you also on the exteriors find out that X amount of HVACs you think need to be replaced, and there's more things that are uncovered. So your budget then, let's say, balloons from $4 million to $6 million.
Right. So basically per door, we thought it was going to be $10,000 a unit, and now it's actually closer to $13,000, which blows up the underwriting, or maybe it doesn't blow up the underwriting, but now you've got to raise, an extra $2 million potentially for the deal, right?
Yep. Or have to try to renegotiate a price reduction with the seller, right?
Which every seller loves a retrade. Yeah.
So that's, if you just look at $40 million price, $4 million
Right.
budget, if the budget goes up to $6 million, where are you going to get that back?
Yeah,
you have to get the price down to $38 million.
Yeah, someone's going to have to eat that cost, unfortunately, right? So, or at least, there's a conversation to try to negotiate it and change it around to our point there. So we look for, when we go on that, to go through about 10% of the units. So let's say if it's a 300 unit property, we want to go through about 30 random ones that are blind outside of course, the base, which would be, a model unit, and then the, likely stock and original unit. So, and then we also are trying to get financial reporting on some of the units as well. How in-depth are the financial reports that we look to seek there? What does it kind of show? Can you kind of give us an inside look at what we'd be looking for and what we'd be trying to figure out in that process there?
So specifically on the early access, you're going to want to look at the lease files and do a lease file audit to ensure that what they are claiming on the rent roll is true. Mm-hmm. Because there's people out there who play games with their numbers. And if you're going to be bidding and paying money for a property based on the seller providing you their T12 and rent roll, you want to make sure that that is as accurate as possible. So the information you're relying on is accurate. So if they're claiming the property is 95% occupied, doing an inspection on the lease files and making sure that, okay, I'm checking out this lease. Does this person actually live here? Are they actually paying the rent? And try to reconcile that that is true. So it's not as much of a I wouldn't say it's as much of a fact-finding exercise in the lease files. It's more of a confirmatory due diligence to see that have the financials that have been provided to us thus far, which is standard practice. I mean, if you're looking to sell a deal, you're going to be showing your P&L and your rent roll at a minimum, right? So that's not anything that is withheld prior to due diligence or prior to an early access. So you already have all that. You've already used that to underwrite. Now you're just coming in and doing a quick spot check.
Very cool. And can you also break down what a lease file audit is? Because I don't think everyone knows what that means. So it's just basically just a breakdown of who the tenants are. Can you just kind of dissect that a bit, please?
Yep. So you're actually going to pick out a lease, and you're going to look at the lease, and you're going to say, okay, who is this person? Does their name for the unit, unit 201, and X person lives at unit 201. Well, on the rent roll, does it say their name? Okay, great. How old are they? Where do they work? What's their income? What's the rent that they're paying? Are there any concessions? Another thing that can be hidden in a sales process are collections and concessions. So collections, and this is, I feel like we've talked about this before.
I don't think, this is a very...
No big deal. I'm going to repeat myself,
Yeah.
But collections are interesting because people assume that if you don't collect rent, that should show up as a loss on your P&L. But that's not true. It actually hits your balance sheet first. And because when you are owed rent that you haven't collected, that's an asset to you, right? If I owe you money, you have a loan outstanding, that's an asset on your balance sheet.
Debit versus credit, right?
Yeah. So for a property, if there's rents that are owed to the property that the property has yet to collect, that will show up on the balance sheet as delinquent rent, and that's an asset on the balance sheet. However, eventually, if that delinquent rent is deemed uncollectible and you give up on trying to collect it, you're going to write that asset off your balance sheet. And then at that point in time, it's going to hit your income statement as a loss. So what a seller can do is try to play games and move things around from the P&L to the balance sheet and back and forth.
You mean a seller might manipulate the numbers prior to exiting a deal? That would happen?
Maybe once or twice before.
Right.
I don't know. It's extremely rare.
Right, yeah. It never happened. No one ever would want to massage numbers for their own benefit. Not in this business or any other business.
Not when there's millions of dollars at stake.
Yes, of course. Especially when it's maybe $15 spread across 300 units x 12, which equals y, which creates a couple of dollars or millions of dollars in value, right?
So collections are the other thing, and bank statements, general ledger, and looking at their AR, which is their accounts receivables report, and you want to track that and see how much rent are you actually collecting and what's hitting the bank and all that kind of stuff. So collections are something that people can play games with, but the other piece are concessions. And so a concession, like I said, with the lease file audit is, well, the rent on the unit might be $1,200, but is there some sort of concession to where that tenant is actually only paying $1,000? Did they get the first month free? Did they get a free TV upon move-in? Do they get an Amazon gift card? Understanding concessions is critical to understand what the true income potential is of that unit. So when we're talking about lease file audits, that's what you're looking at is the income demographics and just validating what is put on the rent roll.
Which makes me think about regards to concessions, and this is not specific to our market here, what we buy in Texas, but I recall during COVID, you got, and many people in New York City and also San Francisco got sweetheart deals. What I mean by a sweetheart deal is it's very interesting. So these cities are heavily rent controlled, right? So not the markets that we would ever want to invest in, nor our investors as they're looking to get out of those places where it's not as landlord friendly. But what was occurring on these concessions, just as an idea, they would give maybe 6 months free on a 24-month lease, because if they lock the pricing in, let's say at $3,000 and it would average out to the same end result, they'd prefer to give you a couple months free and then lock you at a higher price, because then they can only incrementally increase that number. So if the true rent, let's say, is $3,500, they would give you 6 months free, so they could increase off the $3,500, not the $3,000. So didn't you have something like that on your prior apartment, correct, during the COVID process?
I may have pulled off some good negotiations
Yeah,
during
some
that
do
time.
there. Yeah, well, I guess it wouldn't be the first contract you've ever negotiated in your life. So.
Yeah, no, I know a thing or two about real estate.
Exactly, yeah, that's correct. And then San Francisco, similarly, I know a lot of people were experiencing that on their end when I had some friends that were living in that city to kind of give themselves better rent, but they were working to get a lower basis as opposed to a concession, because if they got a good price there, you could be in a place for a very long time without having your rent get out of control when those markets did come back theoretically. So just a side tangent note there, but I guess following up on all the great information you provided there, what would be, reasons why, I guess, or on both ends, why each party wouldn't want to relinquish or wouldn't want to give up the lease file audit to a party like you, to us, I guess?
Yeah, I think sellers have a worry about just disturbing the property operations. And I know that sounds a little bit silly. It is a little bit silly. I think if you are serious about selling a property, you need to be prepared to open yourself up to due diligence and scrutiny. However, oftentimes sellers are looking to conduct a sales process quietly. They don't want their staff to know, which makes perfect sense, because if the staff at the property find out that you're selling the property, they are worried about their job, and that can cause issues. So you don't want to unnecessarily disturb the operations of the property, have all these people show up, do due diligence on the property. The on-site employees are wondering what's going on. Are they gonna get their jobs taken away? Are they gonna go to another property for the owner? So that's not attractive, and that needs to be carefully planned out. Just to take that example further, if a seller's trying to sell a deal for months and the property staff on site is aware of that and is helping facilitate these various due diligence processes, they're going to get sale fatigue, is what it's called. And so the on-site staff is going to just get tired of, when is the sale happening? When's the deal going to close? And do I have financial security? Or, because what they do is they'll just leave before the sale goes through, because they don't know if they're going to get their job taken away or not. They'll just jump ship and go to get another job right away where they feel they have more security. So that is all tough. And it's also another thing that relates to sale fatigue is the on-site staff can get tired of managing the property for a sale. What you want to do as an owner and a manager is to manicure and manage the property as best as you can leading up and through the sale to help the buyer pay the highest price and get the best financing. Now, what if that sale goes through, right? The team has been working really hard to manicure and manage, and then the sale falls through. Then they're like, oh, I thought we were going to sell.
Never do this process again.
Yep, I thought I was going to get a sale bonus, and so they get tired, and then you sometimes see the property operations dip, actually.
Interesting. Okay, so that's why. And then I guess more than anything else, every transaction is heavily negotiated, and it's a nice bargaining chip that the seller can kind of hold. Maybe, hey, we'll give you early access if you give us a couple more bucks on the purchase price, right? So it's an interesting kind of inside look at the negotiation process and some of the ins and outs that we go through our due diligence process. And we are in a shifting time right now, as many people have probably heard. If you're following the commercial market and specifically the institutional asset market with 150 plus units, so very insightful there. So thank you for that. Now let's get into what we've been working on for several months prior and our event that just happened, which was the 3rd annual Lone Star Summit. So first off, I just want to say this. We all work really hard on the team, but the person who spearheaded this the most, I would say, was Dasha Beardsley, Rob's sister, who we had on. So a massive shout out to Dasha for crushing it, and I mean absolutely raising the bar from what we thought was an incredible event the last year to really setting a new standard. And now we've got to keep on figuring out ways to be creative, to one-up it, and provide the best experience for those who come out all the way to New York City from all over the place, with people from Hawaii, Canada, Florida, Seattle, San Diego, and everywhere else in between to come to our event. So it's very special. So Dasha, thank you so much for really blowing it out of the park, for coordinating everything, And then a big thank you, of course, to everyone who came to the event and gave us their precious time. Money is one thing that will come and go, but your time, you can never get back. But the biggest thing we want to do is make sure that everyone leaves with a tangible relationship where they can hopefully transact with them or network or basically grow to their pool of contacts. So really the base of our conference is networking. With that said, why don't you kind of give us your thoughts?
Yeah, I thought it was a great event. I enjoyed the Shark Tank, and I'll just kind of speak through the agenda just as my thoughts go there. So we started the first morning off with the Shark Tank. And I thought the Shark Tank was good, but not great. I think we definitely need to improve that if we even do decide to bring the Shark Tank back. And I do think we will. I think it's a great format.
Maybe just two, honestly.
Maybe just two. We need to shorten it, tighten it up, make the pitches more engaging. Because as I've discussed with people, the concept is great. It's a really cool idea to be able to pitch real deals that people are doing right now and to have real deal investors act as sharks there on the panel, asking questions and providing their feedback. Very honest feedback, right?
Exactly. Shout out to our great friend at Park Row, Equity, Alan, who will always keep it honest and down the fairway with how he feels. It's the best to hear how he perceives the deal. But the Shark Tank was interesting. Well, I guess we want to just go through the agenda right here. We can kind of through what it was.
Let's keep it rolling. So the Shark Tank, like I said, we will shorten it, we will make it more engaging, and we'll really focus on the sharks rather than the pitch.
And then also what I'm going to do personally, I think, as we move forward, so we'll just do a deep dive into everything, just go line by line for what this was. So what I want to do personally is have the person who's pitching pitch me first, and I will red line it or green line it after that, and just be brutally honest, because at this point, having gone to two of our events, I know what I want to see, and I also, want to make sure that it's the right fit for the audience and that they're going to stay on their agenda. Frankly, only one of the pitches, they're all good, I would say. I don't want to be too negative and like that, but one of the pitches was actually in the time requirement that we asked for. So that was cool, and I actually thought they did a really nice job, and it's kind of unfortunate they went almost too quick through it, so they couldn't show a lot of the important sensitivities and whatnot, which of course is in their pitch, but they wanted to be very conscientious and considerate of everyone's time. So they did really well.
I thought that was perfect. I didn't think that they missed out on being able to do anything. I think it's cool that the Sharks were asking for certain sensitivities, exactly.
Yeah, as opposed to people hey, get to it, right?
Yeah, what's the deal here? So Shark Tank went well, and then we had the speed networking, which
we're breaking exactly. So we had a little networking break, and then the speed networking, which is
so the speed networking was definitely a highlight for many people, and you and I spent a lot of time, as I did last year, putting together all of that matchmaking.
And we actually enhanced it from the year before. So as we said, we really want to have made the premise of this event networking with some content sprinkled in. So with that said, the year before, there was 6 10-minute sessions. This year, we enhanced it to 9, which was really challenging. And the other challenging thing about it is not that we have to figure out who would be a good pairing, is unfortunately, we would love to be more preordained. We'd love for everyone to kind of put their, get all their ducks in a row and know they're coming a month before the event and have that be finalized. The unfortunate reality is we get cancellations all the way basically to the day of and the day before. So we had a very large bulk of the speed networking set up on the day before the event on Sunday prior to the pre-party, and we kind of, I think, woke up around, I woke up at 9 a.m. that day, worked out, and I think I don't know what you did that morning. I'm assuming you worked out, and then it was about 11 a.m. we started doing that, and then we were doing that literally until about 5 p.m.
Yeah.
And then we found out at 5 p.m., oh yeah, hey, sorry, we couldn't make it to the event from 3 or 4 people, which what happens is now we have to go through that again, take people out, and then since I was doing half of them, you were doing half of them, we had bright ideas of connecting many similar people, which is really cool because, we wanted to make sure that, people came and would get someone they could, work with. But the reality is that from that process, we doubled up, which, created its own set of issues as well. But
long story short, you took that personally.
Right.
But it's a lot of work to put these meetings together, but it's really cool. because it's intentional and we know, okay, this person would get value from meeting with this person. And then when they're actually on site meeting, they know they have 10 minutes, they know this is speed networking, and so the small talk gets cut out. That was some of the feedback that I got that people appreciated, is they liked how they were able to just sit down and have a 10-minute meeting and know that, all right, no small talk, what's your name, what do you do, how can we work together?
Yeah, cut to the chase.
Cut to the chase. So people like that, and it's not to say that people at the conference were just robots saying, hey, what can you do for me? What can you do for me, right? There was still plenty of organic networking to be had, but that dedicated hour and a half of 9-10-minute meetings is arguably the most value that you can get out of it, because it's just so tangible and efficient. So,
I think that most people came up to us and were overwhelmed with happiness in reference to the fact that we put them with someone they're going to work with. And it's not a perfect science, unfortunately, but I feel as if we did a very nice job, or at least to the best of our ability, and we're still going to work on improving the process on that end, but I thought that was really cool. And the other thing that I'm looking through this sheet, which makes it even more impactful, is the fact that we actually did this earlier on in our event, because it was a 2-day event. So the fact that people got to meet so many individuals in the front end there was like, oh wait, actually later today during the other networking breaks, I actually need to circle back with this person because there's actually a really nice fit here. So us doing it earlier on in the day, and then also in the event, really was kind of an icebreaker, and also kind of set the agenda and the tone that, oh wait, we're here to meet people and to network. And for those of you who know us pretty well, know that when we go to events, we are not there just to sit down and take notes, but what the speakers are saying, unfortunately, I wish we could be that way, but
sorry to the speakers.
Yeah, and with all due respect to the incredible speakers who put so much time and thought into that, that's not why we're there. We probably spend the least amount of time of any participant in the room without being in the general room, right? So we go and set up meetings during the entirety of all these various conferences we go to. So we kind of put the Lone Star style into this event, which was really, really cool.
Yeah, definitely.
Yeah.
So looking forward to bringing that back and making it bigger and better. When you're talking about speed networking, there's a lot of chaos that's going on because you have to have all these meetings happening at once, so it's loud. You have to organize it such that people can get to their next meeting, find who they need to meet with.
Which I thought the conference space was really...
It worked out.
It worked better than I anticipated. And also, we're almost bearing the lead here, frankly, of just regards to where the conference was. So, of course, we're in the World Trade Center. We're on the 47th floor. Where the event was the 64th floor, which had a unobstructed, incredible view of the Statue of Liberty in the water. And I can't say how much amazing feedback we got. So once again, shout out to Ferdasha for setting that up. And that is actually a really unique venue for it, because only tenants of the One World Trade Center are allowed to rent that space. So the views were incredible, and the way it's set up was it was a bunch of tables in a row, making it very easy for people to get up and get to their next meeting.
Yeah.
So logistically, a lot more sound even than last year, frankly, I thought.
No, much better, and it was sweet. But still, there were, like you said,
Kinks.
last-minute cancellations, which led to people not having a meeting partner.
Or doubling up on some people.
Or
accidentally.
doubling up. And so shout out to our friend Dean, who said, hey, this would be a super easy app to build. Let's just build an app, and we can have it do some sort of if-thens and sorts.
That's the Carnegie Mellon Brain Trust right there and here, of course, where they can think of these things, of course.
Oh yeah. So that would be a really cool app to have people check in the day of, and then that validates their meetings and points them to where they need to go and everything. So yeah, we'll just keep on making it bigger and better. Speed networking, I would say A+, can't wait to bring it back.
Yeah, then the next was lunch, which, by the way, we all have been to conferences where we're excited to eat because, it's a nice breakup. Who doesn't like the eating? It's maybe the best part of the day, every single day. Lunch was incredible day one, so that was awesome. And the next was the equity panel. Can you share the participants of the equity panel for us, please?
So the participants of the equity panel were Jason Ross at Crescent Partners, Christopher Mendez at Pearlmark, and Sam Morris of Sunset Capital.
Yeah, so all of them really great guys, do slightly different things. I think my favorite quote of the day, which I emailed Chris Mendez this, was the fact that he runs Promark, so he was saying that buying right now is a great time, but also buying the next year. And he made this point, which is so profound. He's like, you think these deals are risky? I think the deals the last couple of years were risky because the leverage and everything getting too high. It's like, I think right now in the next year are the best times to buy and the least risky times. So I think for everyone to kind of get a nice sense and refresh about how to recalibrate, how to speak to your investors if you're in our position, or if you're an investor. Just hearing someone who's that sophisticated, this is a Cornell and a Wharton guy saying something like that. This is not some guy on the street pretending as if he's some sort of incredible LP, right? So this is really some just great thoughts and thought leadership in regards to the people that we had on the equity panel. And then, of course, in typical Lone Star fashion, we had a networking break. And then following that, we had a incredible speech by Hunter Thompson.
Yeah, Hunter's a great speaker, great friend.
Mentor.
I believe he was, episode 15 on the show?
That sounds about right,
13,
yeah.
14?
Yeah.
So, yeah,
in that neighborhood.
That was I was really pleased to see how that turned out, because Hunter normally speaks to a different type of audience, and our room was comprised of more so private equity firms and family offices, and a little bit higher sophistication than the real estate entrepreneurs that he usually speaks to.
Well, and it's because he's got multiple businesses, right? He's got his ASIN Capital business, where he's a sponsor, of course, and then he's got his RaisingCapital.com and RaiseMasters business, which is just building up an army of really great fund managers and capital raising partners, for his business, of course, and for folks like us. So it just goes to show how versatile and talented he is, that he could pull off a speech like that. But also, that was his first time doing it, so he created it. He gave your book many plugs, which was cool. But he just really a great friend in person, a mentor. So we're so happy that he was there. And it's kind of cool because last year, totally different speakers, different people in the equity panel. So it's always, I think you probably intentional about this, making it kind of different and fresh every single year, not just the same faces, right?
Yeah, exactly. Well, we'd love to have back a lot of the same people year over year.
Yeah, whoever it may be.
But I think it is great to be able to showcase new people every year. So yeah, that's definitely a part of the strategy as we look to grow the event and grow the network.
Yeah, and then following Hunter's speech, we actually had another networking break, which led into dinner, but between then was about another 35, 40 minutes of people connecting and collaborating together and sharing ideas and sharing ways they can do business with one another.
Yeah, for sure. And then we had a lovely dinner at Reserve Cut.
Whoa, yeah. There's lovely dinners, and then there's excessive economy simulating dinners. And this one was an economy simulator. It was that over the top and decadent.
Very expensive.
Yeah.
We spent more than we'd like to on that dinner, but it is what it is.
Yeah.
But yeah, it was a great time, great turnout, and super, super cool. So,
and then we went from there to walking over as a big group, rolling about 50 deep from Reserve Cut all the way over to the oldest, if I'm not mistaken,
I think
or
so.
At least the most prominent and distinguished cigar bar, arguably in Manhattan, in the financial district, Barclay Rex.
Yep.
In which, at that point, it's been so much lead up because on my end, yes, I was working with Dasha, of course, or Dasha did the bulk of it, but a lot of work kind of leading into it, and we've been basically in 2 weeks straight of working and no fun, just working, and that was it. So I had a couple drinks at dinner, had a couple drinks at Barclay Rex, and had 2 cigars at night. So it was one of those, and when you're in a room with about 50 people smoking cigars, my 2 cigars were one thing, and then I think I probably inhaled another 4 cigars. So that was a lot. I had to, of course, take my suit to the dry cleaner, proceeding day 2, of course, because that cigar reeked. I was planning on wearing the Lone Star Classic navy blue suit. Had to swap in for with the charcoal suit the next day, of course, but never mad when something like that happens, especially when you're just having laughs, really forging great relationships. And I just want to go back to the speed networking is a big part of the event. But not only is the speed networking part of the event, the other part of it, of course, is just the collaboration side. So,
I think people got more drunk last year than this year. I don't know. That's what I noticed. I noticed that last year there was a little more alcohol flowing at the cigar lounge.
Is that so?
Yeah, so it was a little more tame, and I felt myself actually getting tired at 11:30 this time instead of last year. We were going to 1, and we had to shut it off. And yeah, it was interesting. But yeah, it's just been very busy, very productive, and also, like you said, very inspiring, where you're around all of your network, very stimulating, motivating, and you're just excited to get more business done.
Yeah, no, I feel kind of a mental shift on my end about the processes I want to do. And also, going back to the Shark Tank, our friend Ilya with CrowdStreet, and JC. And it was JC, Ilya, and Alan really gave some of the best feedback on the pitches, which was how they want to see a deal, how they want to look at the deal, and how it should be structured, done, and how to deliver it. And these are people that look at deals all day long, and these are some of the bigger capital managers in the nation, frankly, right? So hearing how they want it to be done and the way they want it to be delivered was something that we should probably go back and rewatch and kind of tailor our pitching and our messaging to.
100%.
That was really beneficial.
And it's such an important topic, and people, we definitely pay a lot of attention to this, but we have room for improvement as well. But just talking about how do you email a deal? How do you set up a data room? How do you set up a pitch deck? How do you set up a one-page memo?
The infrastructure.
How do you host and run a webinar? So all of those pieces have to be thoughtful in the presentation, what information you're presenting, in what order, and how much.
Right. Very well said. So yeah, the real connections were made. It's funny. I can't even tell how many people came up to me. More people know you, of course. You've met more people in the room, but like, oh yeah, it's so funny. You've called me so many times. It's nice to actually finally put a face to the name, and vice versa. So it was so great to do that. And then it's getting into day 2 of the event. Debt panel, which we had some of the best debt providers. JC, of course, was on that as well. Nate Lowy, and then also Nick Diamond, I believe, with Lumet, correct? So,
yep, and Johnny King.
And Johnny King. Can't forget our friend Johnny. They were awesome. It was really insightful, as debt is such a hot ticket right now, and a big item. Yeah, crack that bubbly, of course, which we've gone through a sickening amount of bubblies the last week or so. I think you may lead the league in cans on Murray Street for gone through. But yeah, so debt panel was great. It was really fun to hear kind of what's going on there. And I think more than how equity was kind of a more important conversation last year, debt is right now is way more important. And I think the amount of questions were really cool, because people were intently listening about how we get out of these situations, maybe how they need to navigate their deals, and maybe what to look for. So these are some of the best debt people in the country that were on that panel.
Yep, 100%. Debt's super important, and it's really important right now. Everyone's nervous about debt, whether they're talking about an acquisition or they're talking about their existing portfolio. So that was a fun panel. I was the moderator for that panel,
and also the equity panel too.
And the equity panel, which puts pressure on me to come up with insightful questions, because
and follow-up questions.
Nobody wants to just run a boring equity panel or debt panel and just talk about, hey, so tell me about your background, and
the
tell
treasury's
me about
here, and there's floating rate debt and bridge debt, and but the personalities and flavor of the people on the debt panel was second to none. I mean, JC is just a total gentleman. Nate is one of the funnier people we're going to talk to, and then Johnny King is just a great guy, and then Nick with Lumen is just super professional and on it. So.
Yeah, it was good. So what did we have next?
Yeah, so following the debt panel, we actually cut out the networking break, and I hosted and moderated the investor relations and marketing panel, who accompanied me on that panel, and where the panelists were Hunter Thompson, Sam Morris again, Dasha Beardsley, the great Dasha Beardsley, who can throw the best event in all of New York City.
True.
And Sam Silverman. So that was really fun for me. I had some good questions, and they were just kind of walking through kind of what they're experiencing from a capital raising side right now, how they're managing and following up with their investors, and then also just their communication process, because there's some deals that they're in with capital calls. How are they managing those communications? What's it like right now, raising capital in a more difficult environment, because the last 3 years it's been hot money entering the space.
Yeah, that's a great topic, and I liked the investor relations angle. Last year we had Ryan Gibson on, and everyone loved what he had to say about investor relations and gifts and being thoughtful and proactive and stuff like that. It's the little things that really do count. So that stuff's super tactical, really helpful.
Yeah, as our friend Hunter Thompson says, we all have a 14 to 17% IRR. How can you make yourself different and not a commodity? And those people on the stage have really done a great job, or on the panel, I should say, really have done a great job in their career to distinguish themselves. So just great role models and people that we had there to hear their insights and to have their brain picked a little bit more deeply. So that was fun for me to do as I get more to speaking and to being on panels and moderating. It's good practice for me. The way I thought of it, I was like, okay, Craig, it's just a live podcast, but on that one, I didn't talk very much. I just asked questions and inserted myself ever so slightly. And then I was really pleased with the follow-up questions that the audience had to the thoughtful responses and thoughts that our panelists had.
Beautiful.
And then following that was a networking break, and then following the networking break was a small group breakout discussion, which I thought was really cool. I don't think we had that last year.
Nope.
I definitely think that's something we should do. I think what I would like to do from a structure perspective would be to have a small group networking to start, and then maybe a lunch break, and then the speed networking so more people can trickle in for the speed networking from there. So that would be maybe something I'd switch around. It doesn't have to be that way, but that would be, come forward please for the frame. That would be something I would think about.
Interesting. Yes, the small group discussions was a new thing for us. And I had a pretty good group, and we had a nice conversation, and we kind of
Well, I wonder
bounced
who
around.
selected your group.
Yeah. So we get bounced around and talked about acquisitions. We talked about what we're seeing in the market, kind of stuff like that. The intention of it is kind of break down the barriers and really talk about specifically what people are going through, what challenges might they be facing in their business, and kind of talking through those things on a more personal level in a small group format. So I don't know, I wasn't obviously in your group, I was in my own group, so how was your group?
My group was really great. I think the biggest thing that I want to do is everyone to introduce themselves once more, kind of state why they want to come to the event, what they were looking to learn, what they want to learn coming up, and then also kind of what they were seeing in their respective place of business, whether it be the market that they were in, what's kind of going on in their business. So probably similar to yours, some other good templates that we have from a question perspective, which you very nicely came up with. So it was just kind of a free-flowing conversation, and I had Sam Morris in my group. Sam is so brilliant. We got to really connect more. We went to a Taste of Texas with him in Houston. I want to say within the last 12 months, or about 9 to 12 months ago. He's such a gentleman, but got to really connect with him more on this trip, and I hope actually he could be on our podcast at some point as well. We could pull up to him in Houston. We could go to a great meal with him, of course, and eat some of the best food in the world and in the country, which is, of course, in Houston, which we've discussed. But I really kind of wanted people to kind of see and hear some of the insights and kind of spotlight Sam a lot as he is such a wealth of information and knowledge, and really, as I said, this event is about networking and resources and kind of pulling your people together. So I really did a good job to spotlight him and to kind of have him give his insights in conjunction to what other people in our group had to offer.
Very cool. Yeah, so we'll definitely bring that back next year and
must.
have to find some ways to improve upon it. So with that being said, how many people came up to you and said, this is the best real estate conference I'd ever been to?
So many people did say that. Maybe they're just saying that. Maybe they're just being flattering. You can always flatter me. I'm always open to be in receipt of flattery. So just for the record. But I would say many people had said that. And the biggest thing I will say is maybe that wasn't the best conference you've ever been to, but it was more than anything else worth their time and money. So having something be worth someone's time and money is just a huge compliment, because everyone loves value, and I think we really delivered value and then some for this particular event, which was great. So I was just really grateful that people felt so appreciative and had such a good time, because we had a good time. There's a lot of work getting up to it, but yeah, so I mean, I think everyone really enjoyed it and got their money's worth and got what they came there for. How about yourself?
Yeah, multiple people came up to me and said that they really loved the event and it's the best event they've ever been to and all that stuff. So that's great to hear, and I really do appreciate, like you said, their willingness to travel, fly across the country, spend time with us and everything. That's really important. So to everybody listening that did attend, thank you so much for coming. And if you do have feedback, which we've already received some, so thank you for that. But if you do have feedback and want to help us make next year better, please send us an email with your honest thoughts, and we will absolutely take it into consideration.
You know who the biggest star and biggest asset to the event was, which you didn't think was going to happen, but we have to shout out two of the most important people on this show that have never been on this show, because without those two, we wouldn't have the show. and that would be Todd and Ina Beardsley.
Yes.
You want to dive into kind of some of the comments you got? I'll let you take the lead on this one as it's your family.
This was really interesting and honestly eye-opening.
So special.
So months before this event, obviously my sister Dasha works with us here, and it's it's not really a family business, but we kind of are making it feel like a family business, right?
I mean, if you feel like my brother to me at this point, and I think vice versa, right?
And Dasha
is like a sister to me. Dasha is like my best girlfriend at this point,
right? So we do have family here, and my parents are close and involved, not involved in the business, but involved in our lives, and
very much so. I mean, you guys are. I mean, I'll just interject here real quick, which I've never done before in my life, but your family is particularly close. I mean, I'm close with my family, but I think you guys are slightly closer. I mean, I have more siblings, so there's more going on there, but you and your family do a very awesome job to be tight-knit, which is beautiful.
Totally. So months ago, my parents were excited about the event and the fact that Dasha is putting all this effort into it and that, we're hosting it and all that, so they asked if they could come. And we said, of course you can come, no problem. My mom's always nervous about embarrassing us or saying the wrong thing, and
understandably so, perhaps. Yeah.
Understandably so, but no problem. Come, of course. But I didn't think anything of it. I thought, oh, well, they'll come and they'll enjoy themselves. And also, they're in real estate, so they can meet some of the people that we've connected them with and helped, with their investments and done business with and stuff. So, but the eye-opener and what was so amazing was the feedback that we got, that people really, really appreciated getting to see my parents and see, the interaction between the Beardsley family, right? And so it humanized us and it built trust. So that was really cool. That was unexpected, and a lot of investors actually came up to us, came up to me.
So many family offices that were there.
Right, and so that's something I'd never thought of before. And that's the idea that a family office, which is essentially not always set up this way, but is essentially a family business, they appreciate other family businesses, right? Duh, it's a no-brainer. But people that have a focus on family, they said, wow, your parents being here, Rob, this humanized you. This made you a lot more trustworthy, and I connect with you more. And that, I had no idea. I did not think that would be the case. And so it was a total home run, and we definitely got our money's worth for that. It was amazing.
Talk about an unseen benefit. Shout out to a very big theme to Hunter Thompson's keynote, and something he'll probably be harping on moving forward is the unseen benefits, whether it be raising capital or whether it be hosting an incredible event at the finest building in New York. Having your parents there was such a hit. So I think some people said, frankly, I think with all due respect to the incredible people there, the 5 of the biggest, most prominent families that were there and people that were there all mentioned and all actually said specifically and mentioned your parents and how that was so wonderful being there. So maybe we should have your family around more. Actually, this makes me think, if we ever have any sort of Mixer and Lone Star event, they need to be here at it.
I mean,
it doesn't matter if it's donating blood, if it's the spring office mixer, if we're having biannual events. Seemingly, they need to be there and be present and to be kind of mixing it up.
We need to, we need to hire my parents onto the investor relations team.
Right. Maybe let's take my job. Perfect. Yeah.
Exactly.
Cool. Any other wrapping up or final thoughts?
Yeah. So let's talk about how we think we can make the event better next year.
Okay. Well, I think 2 pitches, not 1 pitch. I think this year is uniquely different due to the market not providing too many options for a lot of live deals to come. But I think a sponsor, the direct sponsor, which I think 2 of the 3 deals it was a direct sponsor, but just moving forward, the direct sponsor needs to be doing the Shark Tank pitch if we want to do that, and only 2 pitches, have it condensed, 1 hour tops on that to start. It's a lot to ask for people to like that. I would do maybe small breakout networking to start first, then maybe the lunch, and then I would go to speed networking. And the reason why I want the small group breakouts on perhaps the first day would be that, well, actually, now thinking about it, maybe we do 2 sessions of speed networking the first and second day if we have a second day.
Well, I don't think we should have a second day.
I'm gonna have to really marinate on that thought. I trust your opinion so much, But I think a second day is necessary. If people want to come, they can come. If they don't want to come, they don't have to come.
Yeah, I don't like a couple things. I don't like how, if we're going to have the big shebang of dinner and cigars and stay up super late, I don't like to stay up super late and encourage everyone to do so.
And then have come in at
with,
8 a.m.
with the looming thought of I have to be up super early to come in for day 2.
So you want people to blow it out.
I want the event to not end kind of on a flat note day 2 at lunch. I want it to end on a high note at 1 a.m. when everyone's enjoying their scotch and cigars, and if they choose to go on to the night even further, they can do so and just really have a full night of it, right? So that's one part I don't like. The other part I don't like is just how much the crowd thins out day 2. That is demoralizing, frankly. So
Okay.
I think it is an inevitability, especially when you talk about the type of conference that we have, because the guests that we have, the majority of them are not willing to do day 2. That's just what it is, right? They're busy. They're family office, private equity firm, a big investor of ours. It's not realistic to ask them to come. Or they don't want to. They just don't. So the crowd thins out to an unfair degree to those who want to speak or who we're inviting to speak on day 2.
Yeah, you're right. And people only have so much attention span. And I guess if you put a larger emphasis on the first day, that's fine. We can maybe extend out the event a little bit longer and delay everything. So that could be a potential option. And then my thought on this would be to have a bigger day 0, basically a pre-party. So that's one thing. And then you also mentioned another creative idea, which was having no VIP or GA, but one ticket where everyone is included to it. So maybe walk us through, your thought on that.
Yeah, I think that's also better rather than putting people into different categories. Oh, you're a general. Oh, you're a VIP. I think it's just better to just raise the bar and basically make everybody that comes a VIP.
Okay.
And that's in alignment with our goal of having a small event, because you only really want to do the general ticket if you want to sell a lot of tickets. But if we're going to essentially keep the event small and want everybody to be a VIP, that's perfect, right? Those are in alignment, because the definition of VIP is for it to be selective, and also the activities that we're doing, we can only do a limited number of people. So I think we just, honestly, like truly, I think the value that we are offering in the room, people would think we're crazy. Like, what do you mean? You're inviting all of your top investors and you're just selling a ticket to be in that room for $1,500?
I want to say this right now. If you're an operator listening to this and you weren't at our event, you did yourself a massive disservice. If you're looking to raise money, you would be very silly. Yes, you'd be very silly to not be in the room to soak in some of that equity opportunity.
Yeah, no, people think we're crazy, and it might be crazy, honestly. So that's why I think we do need to switch it up a little bit, keep it intimate, keep it small, and maybe even make it available only on an admission process.
Well, I do think there should be kind of a pending ticket process, perhaps.
Yeah.
Like, hey, and yeah, to curate a better environment, as you alluded to and mentioned, this is not to make money. This is to have legitimate connections, and I'm sure Kent and you know the ins and outs of the business, the financials, but I'm sure you'd be okay with maybe even losing a bit of money.
Correct.
So also, one thing that was cool that we didn't mention on now is you and Kent made the decision, of course, on the front end to donate all the profits of the events to Israel, which I thought was special, and to everyone that's involved in the Middle East conflict right now in that a region on all sides. We are very sympathetic to it. But Kent, of course, being in his community, found a great charity that was going to help with, I think, medical resources to people near and dear to him. So that was cool to see. So just want to say our thoughts are to all people on both sides, whatever it may be. No one wants to see any conflict or war. So just thoughts are out to everyone who's affected in this process. But yeah, we donated all the proceeds to victims of what's going on currently. So,
Yep.
Yeah. So we led with that. You did a very nice job with the moment of silence. I emceed until you pinch hit yourself into the emceeing role, which was nice. So maybe one year he'll sit back, relax, and let me run the show. And then I think next year you need to do the keynote.
Yes, that's right.
And the biggest thing is these keynotes, Hunter crushed it. It is exactly what we wanted to see. So he really, shout out to our boy Hunter once more. He did such a good job. But that's what we wanted of it. I think actually it's kind of cool. He's like, all right, how many people here raise money? And basically everyone raised money, but for him, so genius. Okay, let me just qualify who's here for my ASIN capital deals, and also for my end, it's like, okay, you not that I didn't already know on the front end, but that was cool. So, but yeah, I think anything else you want to do before we conclude?
No, I mean, we need to get feedback, so we're going to send out a survey to the attendees and ask for feedback on how we can improve, and I'm sure we'll think of other ideas along the way. We'll probably start planning in earnest. So the way that Dosh and I do it is we start really planning and setting everything going around the end of the year. So around the holidays, and then...
Well, it's a little slower on everything
Yeah,
else.
well, it's slower, and we're with family, just hanging out, doing nothing. We can start planning the event. So it's crazy. We start planning the event...
In a month, basically.
Call it end of December, Jan 1, for an event that we host in September, October. But that's how it goes. And so...
No rest for the wicked.
No rest for the wicked.
There's about 75-ish days left, maybe or less left in the year. Maximize the rest of your days. If you're, looking to learn more about how you can work with Lone Star Capital, get into our ecosystem of becoming an LP investor, a JV investor, maybe perhaps, raise money for us, whatever it may be, or any questions or want to provide feedback for this show. If you want to work with us in any way or have mailbox questions for us, my email is craig@lscre.com. Thank you so much for listening to this episode and the ones in the future and the ones in the past. We look forward to connecting with you guys more like we did with everyone else before. We're riding off a very high from the event. We look forward to seeing you next week on this show. Peace.